Jordan's first idea is an outfit called Payfare, P-A-Y, on the TSX. What do they do?
So Payfare is a Canadian fintech company that allows gig workers to have instant access to their money. So the best way to explain it is through an example. Think of an Uber driver that completes a ride, and normally they'd have to wait 2 weeks to get paid. Well, with Payfare's solution, their money can actually be instantly deposited onto a Payfare-issued credit card. And when the driver goes and spends the money on that credit card, Payfare takes a piece of the merchant fee. So it's a very unique model in that there's no cost to Uber, and there's also no cost to the driver. It's fully funded by the merchant's fees, which they're used to paying anyway. So really interesting company. It was an early mover in this gig space. They have established relationships with Uber, Lyft, and DoorDash, so the three biggest players in the space already. And what I'm really excited about is they're actually looking now to take their technology and their solution and apply it outside of the gig space. So imagine, for example, a McDonald's worker or a Tim Hortons worker that wants instant access to their money after a shift instead of waiting for a traditional 2-week pay cycle.
That's interesting, yeah. And is it a branded credit card, or what sort of credit card?
It would be a Payfare, Visa, or MasterCard, yes.
Oh, I see, okay.
Yes,
yeah.
and the thing I like about this company is super high growth in a very fast-growing space. So the gig space is growing about 25% a year on its own. I don't know about you, Andy. I'm only using Uber and DoorDash more and more over time. So very fast grower, decent valuation, very high return on equity, and I do think more and more people will become familiar with this name going forward, and the stock will do very well. Innumerable
people must be ordering food in Toronto, judging by the number of delivery drivers going around.
Well, you know, it's interesting, in talking to the company, the fastest growing area of these delivery services is actually last mile delivery. So there was an example the CEO gave of, forgetting a phone charger at a meeting, needing one, going on the app, ordering one, and having a charger delivered to the restaurant he was at within 20 minutes.
Oh, super fast, yep. Foraco is your next idea, and you say this stock could produce a rich return?
Yes, so it's Foraco. It's a company that's been around for about 60 years. They're actually based in France, but trade here in Canada. It's a mining drilling services business. They operate across several different global mining jurisdictions. Management's done some interesting things over the past couple of years. They've focused on less volatile geographic jurisdictions. That's number one. They've also focused on EV metals, so things like cobalt and lithium, for example. So I think there's a bit of an indirect EV play here. But if you look at the financials, there's been very steady progress on the top line, very steady progress on the bottom line. A couple months ago, they announced that their cost of financing will drop significantly. They didn't say it in the press release, but I believe their cost of debt will go from about 14% down to 8%. So look at their debt cost to be cut in half. This could be the source energy of this year. We talked about, when I was on last year, talking about source energy being a double. I think Foraco could be a double. You could see this as a $4 stock within the next 12 months.
How would they differ from other players, such as Major Drilling, for example?
Yeah, and that's a great example. That's the peer that they're often compared to. So in terms of the business itself, I would say Foraco focuses on slightly more complex drilling. The other big difference would just be the quality of the financials. It trades at a fraction of the valuation with way higher growth, higher margins. If we can get anywhere close to Major Drilling's multiple on Foraco, the investors are going to be very happy.
And a French company based in Marseille, apparently.
Correct. The business was originally founded there, sold to two gentlemen who were running it for a number of years, and then the current management team took over last year. The CEO is actually based here in Ontario now.
Okay, and they say they're the third largest global mineral driller. Okay, and then finally another fintech company, Propel Holdings, PRL. We've talked to the CEO a few times.
Sure. So Propel, for those who are not familiar, is an online lender. They provide consumers, mostly in the U.S., with fast access to things like lines of credit and loans. They've done an exceptional job growing the business. So they went public in late 2021. Those looking at the chart might think they missed it. The stock had a big move a couple months ago. I don't think that's the case, and let me tell you why. If you look at where they were at the time of the IPO a couple years ago, I think they had about 130 million of revenue, maybe 9 or 10 million of profits. This year, our forecast is for their revenue to be about 3 times higher than it was just 2 years ago, for their profits to be 5 times higher than it was just 2 years ago. And the stock's only gone up 30% since the IPO. So don't let the chart fool you. There's a huge dislocation here. This stock has something for everyone. It has a very high growth rate for the growth investors. It has a single-digit PE for the value investors. And it's also got a very healthy 3.5% yield for the yield investors. So I think this one checks all the boxes. And despite the recent move in the stock, I think a year from now, you're going to see this stock materially higher.
And they use AI to judge potential borrowers.
Their technology is incredible. They've invested a lot of time and money. They have a huge team that's working on this. And believe it or not, Andy, they can look at 1,000 variables on a borrower in under 10 seconds. It's quite remarkable.
Jordan, we better leave it there. Thank you very much. You gave us loads of ideas.
Thank you so much for having me.
First idea, Air Canada.
Yeah, we love Air Canada at these levels. It trades at about 3.5 times EV to EBITDA, which is about 6 times earnings. Historically, it's traded at 4.5 times over time, so on average, so well below historical averages. And the overhang for Air Canada has been the never-ending wait for the recession. And then also we have some headwinds coming up in terms of the pilot negotiations and the more competitive Canadian environment, domestic environment. But as we look out into the future, that Air Canada is about, I think, 97, 98% capacity back to 2019, so almost back at full capacity. They're adding to their Asia-Pacific routes, which is some of the more profitable routes. Mm-hmm. And when you look at the mix of business between 5 years ago today, domestic is less than 30%, international is 70%. So they're very well positioned. Their balance sheet is much better than it was 3 or 4 years ago during COVID. So if the stock can only trade back to, let's say, 4 times EV to EBITDA, assuming that the EBITDA doesn't go down dramatically, then their stock should be trading up into the $30 range.
But they did take more debt on, though, during the pandemic, didn't they?
Yeah, it used to trade at 5 times EV to EBITDA, and now it's down to 1 times.
Right.
On debt to EBITDA, sorry.
Debt to EBITDA,
yeah.
Right. And why has the stock not got back up to pre-pandemic levels, do you think?
I think it's that overhang. It's the global slowdown. Mm-hmm. It's fuel prices going up and down. It's their negative. There's a lot of bad press in terms of consumer, mm-hmm. how they treat their passengers and that sort of thing. So.
Idea number 2, LVMH, luxury, play on luxury, but China's slowdown, that's not a worry here?
It sure is, but the stock reflects it. And it's been a worry for LVMH, not only for China, but for the whole world, because they benefit from global travel, especially domestic Chinese travelers around the world. So that's slowed down, and that's why the stock has gone from almost 200 down to 140 here. We owned the stock a long time ago, but we were selling it at closer to the $200 level, and now we're looking at buying it back because we believe the company, which owns Tiffany, Bulgari, Sephora, and 70 other well-known brands, has a track record of stability, growth, margin improvement, and there's little, for most of their brands, pricing power is something they have. So we like that in the stock. Over time, when we look at ROIC, return on invested capital, the variation in return on invested capital over time is very little. Mm-hmm. It's pretty much steady at 15, 16%, which is very attractive. When you look at some of the higher end spectrum of ROICs for the luxury group, mm-hmm. Their ROICs swing hugely with the cycles, not LVMH, because they have such a broad bench of brands. So at 21 times, this year's estimates for LVMH, mm-hmm. We think it's a very good attractive point because they can grow revenues in the high single digits, and they'll see some leverage on that on the top line and be able to drive 13% EPS growth.
That's interesting. These luxury companies have in the past been known to burn merchandise rather than allow it to go on the market at discounted prices.
I have heard that, yeah.
Sometimes they apparently, I'm not necessarily talking about LVMH here, but luxury manufacturers, they retrieve the minerals, the gold or the leather used, but they don't want that stuff going out at a discount.
Scarcity is important.
Yeah. It's show business in a way.
Is.
Yeah, that's right.
Yeah.
Finally, Starbucks. The stock down over the past year.
Starbucks is a name we bought. I think we bought it about $70 when Schultz was still CEO. There'd been a bit of a revolving door for CEOs previously. They also, at the time when we bought it, China was also shut down. So there's a lot of negativism. We're seeing similar negativism, but not to the same degree we did at $90. It is also trading, ironically, at only 21 times earnings. They have a growth algorithm, which their new CEO is blessed at, I think it's 10%, 5% comparable store sales growth, 10% top line growth, and probably 15% EPS growth is what they want to try to achieve over the next 3 to 5 years, which I think is doable, especially as you see China continue to reopen, because the reopening was the reopening was not a success. However, it will reopen, and also the global markets will recover, which Starbucks definitely has leverage to. I think North America, they're expecting 4% store growth, so that'll be positive for them. So we love Starbucks at these levels of 21 times. We think it can trade back up to 120. Ironically, not ironically, but I think Morgan Stanley upgraded the stock today.
They did, yeah.
Just so everyone knows, I was ahead of them.
I mean,
same price target.
So profitable. I mean, beverages, coffee is such a fundamentally profitable product. So brilliant what they've done.
Yeah, they are innovation is their number one. That's their number one thing, is innovation, continued innovation, and also offering my venti dark coffee every morning.
Oh, that's a good dose of caffeine. Yeah, Michael, thanks very much indeed. Michael Hakes. We get to top picks now. We have touched on this theme, but anyway, top idea, this bond ladder, 1 to 5 years. I mean, it's slightly higher maintenance in that once every year you have to choose a new bond or get your advisor to.
That's right. Well, that's the appeal of this. You get your money back and available for reinvestment. You may choose to buy another 5-year bond with the proceeds, or you maybe do something else with the money. But the point is you get your money back at a specific time in the future, and you get a rate of return on that bond. It's absolutely fixed in the marketplace.
Say, though, we were in normal times where a longer term gives you a higher yield. I mean, you could just go to the longest term bond and simply buy that, but you'd have less stability, I suppose.
Well, that brings up the reinvestment risk topic,
Yes.
Andy, which I think is the other side of the coin here. Yeah, you think 5-year yields are higher than 1-year yields, so I'm going to buy nothing but 5-year bonds here. Well, what happens if yields go up? The value of their 5-year bond goes down. And if you say yields are going to go up, I'm just going to buy a 1-year bond. Well, what happens if yields go down? You have no longer-term bonds to benefit from the falling yield. So it's a reinvestment risk argument. So you don't put all your eggs in 1 year, or short end or long end. You have it covered. You always have something coming due, and you take whatever the market gives you when your money matures. And that's the appeal of a ladder. You don't risk it all by guessing which way the market's going.
I suppose one complication, it could be hard to guess your return because you're constantly buying and selling.
You don't know what your absolute return is going to be, but you know that if you buy, if the 1-year rung in your ladder is yielding 5%, you're going to make 5% on that portion of the portfolio it's in a year. That's a guarantee. But the rest of the portfolio, you don't know what that's going to be worth. But it's still, they're all maturing. They're all heading towards maturity at a steady rate. And if these are discount bonds we're talking about, as we noted in this portfolio, they will amortize towards par. So your rate of return is more assured in that way.
You have another idea for us. It's a very low coupon Government of Canada bond, 0.5%. And sorry, when does it mature?
2030.
Okay. You think this offers a pretty decent yield because it's trading at a discount now?
A huge discount. Back when bond yields were negative and the government was issuing debt at really low coupons, this particular bond was issued. And as you can see, it's had an interesting history. And its appeal is twofold. Number one, it's a deep discount bond. It's a Government of Canada bond, instantly liquid, and offers a good after-tax yield. So, and I think it's that's the longest maturity date I would go to, is a 6-year term. And I think a year from now, we're going to see this bond start to perform well. And it's a high-quality item.
You said, sorry, the longest term maturity you'd go?
Is 30, yeah, 6 years.
6 years.
That's the longest maturity date I would put in a portfolio.
Oh, I'm sorry. Yeah, you touched on that. Okay. And then finally, our parent company is BCE, and you like the look of this 1.65% bond. I'm guessing this was issued when rates were much lower.
That's correct, and that's another reason why I included this. This is a good bond to include in a ladder. It also has after-tax appeal, depending on your province and your tax rate, of about 2.5% after tax, depending on your individual. That's the maximum rates of income tax and capital gains tax. As you can see, this bond lately has gone down along with the rest of the market, but this is a bond that's going to just be fine. It's going to be solid and would be a good element to have in a laddered portfolio, in my opinion. And it's good quality, too.
You talked about negative rates, and we saw them in countries like Denmark and Germany, infamously. We never really got negative rates
Not
here?
No, we didn't. No, we're one of
Yeah.
the few countries that never had a negative rate, and the U.S. as well. But at some point, there was like 13 trillion bonds with negative yields in the world, and we're now down to zero. There's only one negative rate left in the world, and that's the Bank of Japan's overnight rate. It's
So they pay you to borrow money from them?
yeah, you're paying them. Never a great investment. I don't know why anybody bought that stuff.
And
real return bonds were also included in that bag, and they were
really negative, genuinely negative return. Yeah.
So they were not really a great item to own, that's for sure.
But the negative returns, people went on. Why would I'm still baffled as to why somebody would buy a bond with several years to run with a negative return?
Well, you're talking to the kind of same. I have the same question. I don't know why anybody would buy them. I suppose institutions probably can match assets and liabilities, and that's the only thing I can think of, because the market is dominated by institutional investors. And I would say insurance companies and pension funds were probably the only ones who would put them in their portfolio, as long as they had something to offset.
Yes.
The asset.
And I suppose if we had serious deflation, these bonds would have gone up.
Well, I don't want to use that word, deflation. You and I don't want to live in a deflationary world because, first of all, corporations would be going bankrupt all over the place. You'd want to own nothing but government bonds in that case, because balance sheets would be wrecked by deflation.
It's interesting.
And the government, and of course, I'm going to preach a little bit about inflation, Andy, because governments benefit from inflation because they pay back their debt in cheaper and inflated dollars.
Sure. And people are moved up into higher tax rates.
Correct.
Fiscal drag.
This is a real con game that we've got going on here. So I'm not in the camp that says we're going to have disinflation or deflation anytime soon. There's too much money, too much stimulus, and yields are going to rise. So that's my bottom line to all that.
We better jump. Hank, thank you very much. I hope you come back before too long.
Thanks, Andy. It was a pleasure.
Let's get to the top picks. A pharma name, Bristol-Myers Squibb, BMY in New York.
Yeah, these guys are really big on immune oncology. This is another example of put the mailbag out, the train's going to come along and get it. I mean, technically, it doesn't look great there. You can see it's sort of in a nice downtrend. We bought this on this downtrend. They generate a ton of their money in North America. They focus on cardiovascular and cancer stuff, but primarily it's all relating to immune stuff. So it's really, it's very, it's got a wide moat. Just to talk about, we used that phrase before on Amgen, so no one can kind of get into their business very easy. Their pipeline's been a little bit, there's some concern, some analysts that their pipeline, drug companies is always about the pipeline, what's coming down. We think it's pretty good. We think the downside is kind of limited. So, you sort of buy this one, you collect a little bit of a dividend, I believe here. But the big thing with what they do is their products, when they come to market, because they're very specialized, the FDA looks at them and will give them quicker approval. They get sort of more attention because of the stuff they're doing, because it's very rare, very topical. So they have a bit of an easier route for their pipelines to get realized, good pricing power as well. So
a yield of almost 5%.
Yeah.
We've got the next idea. It's been around for a long time. Chemtrade Logistics Income Fund, still an income trust.
Yeah, it's perplexed. I'm not fantastic in taxes, but there must be a great reason why it's still, still like that. You can see the trend. They're kind of volatile. These guys, they're in chemicals. Things that we need every day. We can't live without them. These guys focus on, customers all around the world. North America is their base, but all over the world. Their segments are sulfur and water chemicals, what they call SWC, and then electric chemicals. Most of its customers are water treatments. They've got some in pulp and paper, and then the oil and gas business, so really topical. The recent earnings were really good. They were down on their revenue, but the earnings and the margins were fantastic. They raised their guidance again, and they pay a big fat distribution. Always makes you a bit nervous when it's north of 6%, but it's 6.8%. But this is not one where you take a big position. There's not the biggest company still, but I think it's a great little holding to sort of add in there. If you don't own it, you can buy a 1% position again and just sort of leave it and decide when you want to do it. But it's been a nice performer for us.
So, well, water treatment would be a very stable market anyway.
Yeah, their whole business, even with the the volatility of the other ones, the water treatment is pretty stable. Yeah.
And then your final idea is Arista Networks, ANET. What do they do, Hap?
Now, what these guys do is they're a network equipment provider, and they focus on Ethernet switches and software to data centers, right? So data centers is quite topical. I didn't know we needed so many data centers around the world, but it's data center this, data center that. But these guys are some of the best. Their customers, we talked about Microsoft and Meta. That's some of their big customers. Microsoft and Meta love these guys. It helps to, it's got a structural advantage just by what it does over its competitors in the cloud and enterprise. It's had a big focus on these large customers, but it's modulating its services. So it's letting people kind of do a la carte instead of saying, okay, I gotta buy the whole package. I'm gonna buy components, and it brings in some smaller businesses into creating private networks, private clouds, and makes them more accessible. They've got very, very high profit margins, and really excellent free cash flow, which a lot of fundamental guests you would talk to here. Free cash flow is a big deal.
Oh, yeah.
Yeah, and they've got increasing market share. So this is another good name in tech that was much higher, but we think long-term it's got a great...
it's one of those tech names that didn't get back to its highs of late 2021.
Yeah, it's got a ways to go. We saw that there in the chart. There was a big swoosh down there, and it's sort of now incrementally trying to get back there now. So, but a good name, good mix. We got a healthcare company, we got a sort of industrial company, and then technology. We think three really good names to add.
Hap, thank you very much indeed. Okay, let's get to top picks. Brooke's first idea is a Horizons product, S&P 500 Index ETF, pretty straightforward, HXS.
Right, yeah. So this product, for full disclosure, I do work for Horizons. So this is the S&P 500. I'll tell you why I'm focusing on the S&P 500 versus Canada, and that's the whole point of this. But there's two versions of this product. There's HXS, which it trades on the Canadian exchange, and HXS.U, which is in US dollars.
Okay.
The HXS is also unhedged as well, okay? But you buy in Canadian dollars. So the reason why I selected the S&P 500 is right now that's where the momentum is versus Canada. So we have to make a decision sometimes and say, are we buying the Canadian market or the U.S. market? And right now, we do see the momentum with the U.S. market, and that's largely to do with the technology stocks outperforming. We saw them stumble a little bit at the beginning of the year. They're starting to pick back up again as the market gets narrower and narrower. I think that's the overall trend taking place. And so I, right now, have a favor towards the U.S. stock market versus the Canadian stock market. That may change if we start to see oil start to pick up and the banks do okay. If those two sectors do quite well. But we're not seeing that real strength developing yet, and we're seeing technology do well, so the preference is towards the U.S. market.
Okay. Your next idea is the Materials Select Sector Spider Fund, XLB. So that's a commodity play?
So the materials sector in the U.S. is different than Canada.
Okay.
So the materials sector in Canada is like 60, 70% gold.
Yes.
In the States, the materials sector is 70% chemical stocks. So very, very different. It's good to point out. And so we did see the XLB, so this is 70% chemical stocks, and we'll have some metals and mining in there as well. But we did see that run-up that took place here in late 2023 taking place. But right now we're seeing the economy still doing okay. We haven't seen that contraction take place, and with the money still coming to the market, we expect the material stocks to still do quite well here over the next few months, with the amount of money being flowing into the markets. So from a seasonal basis, the material stocks tend to perform well from around this time, so mid-January, late January into early May as well. So from those two perspectives, seasonality, and also as well, we're expecting the market to do okay here with a fairly stable economy. This is actually a good way to play it.
Okay, and then finally, Snap-on Incorporated, the toolmaker, SNA.
Yeah, so this is a little different. I included it in my book. I write a book every year, and I included that last year. This is really a play on what's taking place right now in the car industry, because what we're seeing is older and older cars, and which need more repairs, and at the same time they're more complex. And from a seasonal point of view, Snap-on tends to perform well, starting actually right now until early May. So what we've seen here is we have seen that run-up take place for Snap-on, which is, here we are very close to its high here, and we're just starting a strong seasonal period, which is a positive. So we'd expect that to actually start to move higher from here if the market holds in here. So Snap-on would be expected to outperform the market over the next few months.
And again, an economically sensitive stock, broadly speaking.
Yeah, absolutely. But at the same time, if the economy does slow, that means that people are going to hold their cars longer and versus getting new cars, which means more repairs, which would benefit Snap-on. So it's got that little bit of a defensive component there as well.
Yeah, it's interesting. Cars always seem to break down, but apparently they do last a lot longer these days.
Well, if you look back, decades ago, they used to rust out. You used to look down the street and people would be, driving around with rusted old cars. But now that doesn't take place, and the engines are, much more reliable, et cetera. So the length of the car life has moved up. Right now in the States, it's 12.2 years for the cars on the street right now.
Right, that's interesting. Yeah. Although they're so expensive to fix, the slightest thing. Yeah.
Well, that's the big problem, and that's also going back to Snap-on. That also benefits them because they're in the repair business. They sell the tools to not only repair but also to diagnose for repairs as well.
Let's leave it there. Thank you very much, Brooke.
Well, thank you very much.